You know that feeling when you're staring at just like a mountain of articles, reports, all this data, and you just wish someone could cut through the noise, tell you what really matters.
Yeah.
That's exactly what we're trying to do here on the Deep Dive. Today, we're embarking on, well, a pretty ambitious exploration into Bitcoin. Not just the basics, but what's its true role in modern investment portfolios? Is it, just a fleeting trend or something? More foundational. Okay, let's unpack this.
Yeah, our mission today is really to distill the most critical insights for you from a pretty rich stack of sources. We've looked at financial analysis comparing traditional assets to Bitcoin, the original white paper itself.
Right, the Satoshi paper?
Exactly. And even a fascinating conversation with Michael Saylor, a big Bitcoin proponent who draws some really striking historical parallels.
Okay.
So we'll help you understand not just what Bitcoin is, but maybe why it matters in, well, a global economy that's changing really fast.
Let's start by setting the stage then, because understanding where we are now is, I think, key to seeing where we might be headed.
Absolutely.
The past decade, by many measures, has been really great for traditional investment portfolios. If you held something like a typical U.S. 60-40 mix,
60% stocks, 40% bonds. Yeah.
right, you probably saw returns higher than the historical averages.
Yeah.
And with pretty low volatility, too.
Yeah.
But what were the underlying forces driving that?
Well, we've actually had some major tailwinds, as you said. Forces that many of our sources are suggesting are probably not sustainable going forward.
Okay.
Think about it. Interest rates. They've trended lower and lower for 40 years.
40 years, wow.
Equity multiples, valuations have expanded to historic levels. And central policymakers globally, they've coordinated to make sure there's plenty of market liquidity.
Just keeping the markets afloat, essentially.
Pretty much. But what happens when those tailwinds, die down? Or even reverse. Take fixed income bonds, for example. The U.S. 10-year Treasury yield, it plummeted from around 15% back in 1981 to less than 1.5% by 2021.
Huge drop.
Massive. And this decline, it artificially boosted asset prices across the board. But it creates two big problems for the future.
Which are?
Well, first, lower yields mean you need to invest much more capital just to hit your return targets, so bonds become less capital efficient.
Right, and you need more money to get the same income.
Exactly. And second, those easy capital gains you got from rates just falling and falling, they simply won't be there anymore. We're already seeing negative real yields on things like TIPS, Treasury, inflation-protected securities.
So after inflation, you're losing money.
You're losing purchasing power. Yeah.
And this could flip the whole narrative for fixed income,
Yeah.
From being the portfolio ballast, the safe part.
Yeah, the anchor.
To being the portfolio anchor in a bad way, dragging down returns and maybe even hurting diversification.
So, okay, a challenging outlook for bonds. What about equities, our stock markets? Were they boosted by the same thing? Yes. A very similar story, actually. Falling interest rates directly impacted equities. They decreased the discount rates used to value future cash flows.
Pulling returns forward.
Well, exactly. Pulled returns from the future into the present. And so today, broad U.S. equity markets look like they're at historically extreme valuations.
Okay.
And this raises a really important question. What do these super high valuations imply about future equity returns?
Right. Can they keep going up?
Well, our sources point to two main camps. There's the new normal argument. They say, okay, higher multiples are justified because modern businesses are different network effects, asset-light models, that kind of thing. Then there's the normalization camp. They argue, no, multiples will revert back to historical levels. And if they do,
Painful returns.
potentially very painful returns. Some forecasts we saw suggest maybe negative 8% annually for U.S. large-cap equities over the next 7 years.
Wow. Minus 8%.
Yeah. Now, regardless of which camp you're in, it's pretty hard to argue that future equity returns are going to match the pace of the last decade. Okay?
And this ultimately reduces the opportunity cost of considering other things, alternatives.
Right. If your traditional stuff isn't likely to do as well, you start looking elsewhere. That makes sense.
Precisely.
So this leads us to the bigger macroeconomic picture. How did we get here? With our financial system seeming so reliant on central authorities stepping in.
Well, the current macro backdrop, it's really a direct result of policies going back, like we said, 40 plus years, we're dealing with just huge global debt levels.
How huge?
The U.S. public debt to GDP is around 130%.
Yeah.
That rivals like the post-World War II era.
Okay, that's significant.
And what's kind of frightening is that number doesn't even account for the massive off-balance sheet liabilities, things like Social Security, Medicare.
The unfunded promises.
Exactly, estimated at over $70 trillion, which just dwarfs the current on-balance sheet debt.
70 trillion.
Yeah. So this fragility, this massive debt load, it's led to an increasing dependence on central policymakers to stabilize the economy whenever there's a hiccup.
It's a pattern that really kicked off after the 1987 Black Monday crash. People often call it the Greenspan put.
The idea that the Fed will always step in and save the market.
Basically, yeah. Creating a sort of safety net or perceived safety net for markets.
So it sounds like a cycle. More debt, more intervention, which maybe leads to more risk-taking, then more debt.
That's the feedback loop many are concerned about.
So how does a system with that much debt ever normalize? How does it get back to something stable?
Well, if we connect this to the bigger picture, a 2011 IMF paper we looked at gives a useful historical analysis. It outlines basically 3 paths for debt normalization.
Okay, what are they?
One is real economic growth. Just grow your way out of it.
The ideal scenario.
The ideal, yeah. Second is restructuring or outright debt default.
Politically very difficult.
Extremely. And the third path is financial repression.
Financial repression. Explain that.
Given current demographic trends, aging populations and policymakers being clearly against sovereign default, financial repression looks like the most likely candidate to many analysts.
Okay.
And it's not like a direct tax you see on your payslip. It's about deliberately repressing the returns on financial assets, especially fixed income bonds,
How?
by keeping interest rates below the rate of inflation, deeply negative real interest rates.
So savers get punished.
Essentially, yeah.
Yeah.
It acts as a subtle tool of taxation for the state, a hidden tax on savings. And it would create a totally different investment environment than what we've all gotten used to.
Losing purchasing power faster.
Much faster, potentially.
Okay, that's unsettling. And it brings us right to inflation, doesn't it? A concept everyone thinks they understand, but maybe we don't, or at least not fully.
Right.
Our sources, particularly Michael Saylor, really challenged the conventional thinking here. He gave economics a D grade on this.
He did. His argument is that economists often reduce really complex things, like inflation or the velocity of money, down to single numbers, these scalars.
Like the CPI number we always hear.
Exactly. Which he argues oversimplifies reality and, frankly, can support a desired political agenda. He says inflation isn't one number, it's a multidimensional vector. It's the change in the price of everything.
Okay, so not just consumer goods.
Right. His example was the pandemic. Central banks lowered rates, bought assets, and said, look, no inflation because consumer demand was locked down. But he argues there was instantaneous, immediate inflation in asset markets, stocks, real estate, leading to that K-shaped recovery. Wall Street soared while Main Street struggled.
Makes sense.
He points to things like the Case-Shiller Housing Index, up 19.2% year-over-year at one point, while the official CPI was announced at, say, 7.9%. He says governments manipulate the market baskets and use hedonic adjustment.
Adjusting for quality changes.
Right, to basically create the inflation rate they prefer.
So it sounds like he's describing a kind of hidden tax on absolutely everyone. How does he frame the impact of this constant money supply expansion?
He uses a really powerful metaphor. He says inflating the money supply is like bleeding the free market to death.
Wow.
He compares it to, those old-time physicians bleeding George Washington, thinking they were helping him, but actually causing harm. He calls it an adiabatic lapse, just draining the energy, the value out of the system.
A slow bleed.
A slow, relentless bleed. And he presents some stark figures. A house bought for $100,000 in 1930, worth $30.5 million in 2022, according to his analysis.
That's huge.
That implies something like a 6.5% annual inflation rate for 92 years straight. A rate, he says, no conventional economist would ever admit to.
Okay.
And he links the S&P 500's famous 10% annual return over a century to about a 7% annual expansion of the money supply, meaning the real economic growth, the actual increase in value, is maybe only 2-3%.
But most of the gains are just more money chasing the same stuff.
A large part of it, according to his view, it's just the money supply expanding. So your purchasing power isn't growing nearly as much as those headline return numbers suggest.
Right. Which raises big questions about who benefits and who gets hurt by this hidden cost.
Exactly. It silently transfers wealth.
Wow. Okay. So that paints a pretty critical picture of the traditional system. If those foundations are shaky or maybe even flawed, where does that leave us? Where do we go? This seems to be where our sources pivot. They propose moving beyond just digital information to something called digital energy. What's the difference? And how does Bitcoin fit into this idea?
Yeah, that's the crucial pivot point. So digital information, that's the internet revolution we've lived through since the 90s, right?
Yeah, email, websites, streaming.
Exactly.
Yeah.
Dematerializing things, music, books, maps, even education. Think about the Sailor Academy offering free college courses online, making knowledge access exponentially cheaper, more widespread. Huge growth, huge utility. But the next wave, what Sailor calls digital energy, promises an even bigger opportunity because it introduces concepts like scarcity, permanence, and property rights into the digital realm in a new way.
And that's where Bitcoin comes in.
That's where Bitcoin comes in, representing arguably the first time in human history we've managed to create digital property properly understood.
Okay, digital property. That sounds important. How is that different from a security like a stock? People often get those confused, especially with crypto.
Yeah, and the distinction is absolutely crucial, according to these sources. So property, in this context, is something sort of naturally occurring or fundamentally uncontrolled, something no one entity or person or government controls. Think land, gold, maybe airwaves.
Okay.
A security, on the other hand, is proprietary. It's controlled by a small group, an issuer. Like shares in Apple, there's a CEO, a board.
Right, someone's in charge.
Exactly. And Bitcoin, by its very design, it's an open, permissionless protocol, no central control. A fixed, predictable supply is considered ethical property in this framework.
Ethical because no one controls it unfairly.
Right. Saylor makes the point that he can promote Bitcoin because he literally cannot change the protocol or print more for himself. It's like promoting gold. He can't make more gold.
Interesting.
And this brings us to another fascinating aspect. Bitcoin is described in one source as the most difficult property that the human race possesses or has yet invented to confiscate.
More difficult than gold or real estate.
Exponentially harder, the argument goes. The idea is if you hold your private keys, often represented by those 12 seed phrases, if you hold them just in your head. Memorized. Someone would literally have to crack your head open and read your mind to take it. Much harder than seizing a car or a house or freezing a bank account or even confiscating stock certificates.
Okay, that's a powerful idea. And the origin story is pretty unique too, right? The anonymous founder, Satoshi Nakamoto, vanished, leaving their own coins untouched. What's the significance of that?
It's huge. The anonymity of Satoshi, the fact their supposed stash of coins never moved, the lack of an initial coin offering or an ICO.
No company behind it initially.
No corporate sponsor, no pre-mine given to insiders. It treated early on with basically no commercial value, plus the simplicity of the core protocol. All these things contribute to its status as common property.
Like a public good almost.
Kind of like a gift to the human race is how some proponents see it. Not a product created for profit. And over its, 13 plus years now, it's overcome huge risks, potential bugs, attempts to ban it. The IRS even came out and classified it as property.
Right, for tax purposes.
Yeah. And despite thousands of attempts to copy it, Bitcoin has kept its dominance. All this further solidifies its position, in the eyes of our sources, as this unique form of digital property.
Okay, so it's this unique digital property, but the tech side can still feel complicated. The sources talk about a layered architecture. Why is that important to understand?
It's really key to grasping the potential, yeah. It's not just one thing, it's a system of layers, like building a city. Each layer does something different.
Okay, break it down. Layer one.
Layer one is the bedrock, the foundation. That's the core Bitcoin blockchain itself. It's designed for maximum security, decentralization, and settling large values. It's not designed for speed.
Like moving gold bars, not buying coffee.
Exactly. The goal is moving large sums of money securely through space and time, and for that value to potentially last forever. To be indestructible, immortal. Think of it like the granite bedrock under Manhattan. You build skyscrapers on it because it won't shift.
Okay, solid foundation. What's layer two?
Layer 2 protocols sit on top of layer 1. The most well-known is the Lightning Network. These are also designed to be open, permissionless, and critically non-custodial.
Meaning you still control your own Bitcoin.
You control your keys, yeah. They use Bitcoin's native token, BTC, for fees, and they are designed for speed. High frequency, small transactions, like moving $5 maybe a billion times a day.
The coffee transactions.
The coffee transactions, the micropayments, happening in seconds for fractions of a penny, but ultimately settling back to the security of layer 1.
Got it. So layer 1 for security, layer 2 for speed and scale. Is there a layer 3?
Yes, layer 3 is basically the custodial layer. Think of exchanges like Binance or Coinbase or other financial services built on top.
Where most people currently buy Bitcoin.
Often, yeah. Here, transactions can happen in milliseconds, often for free because they're happening within the company's own ledger. They provide convenience, user interfaces, customer support, compliance.
But you're trusting them with your Bitcoin.
You are trusting a third party. That's the trade-off. But the crucial difference, proponents argue, compared to the traditional system, is that with Bitcoin, you usually have the option to withdraw your assets to your own layer 1 or layer 2 wallet.
Take self-custody.
Exactly. And that option acts as a powerful deterrent against misbehavior by the layer 3 providers. It allows users to enforce fairness by voting with their feet, or rather, their keys.
Okay, so layers for different needs.
Yeah.
Security, speed, convenience. But you mentioned digital energy transforming things beyond finance. How could that work? That sounds really out there.
This is where it gets really fascinating and maybe potentially revolutionary for the internet itself.
Correct.
The core idea is that digital energy, represented by Bitcoin, which requires real-world energy to create and secure, can introduce a sort of conservation of energy into cyberspace.
What does that mean, practically?
It means you can attach a real-world cost to actions online, addressing fundamental flaws we just accept now. Think about spam. Email spam, comment spam, phishing items, scam bots on Twitter or YouTube.
They're everywhere. Annoying.
Right. And they exist fundamentally because there are basically no consequences for the bad actors. It costs almost nothing to send 1 million spam emails or create 10,000 fake accounts.
Okay.
So Saylor proposes something like an orange check system for social media, built on layer 2, like Lightning.
Like Twitter's blue check, but with Bitcoin.
Kind of, but different purpose. Users would put up a small security deposit, say $10 or $20 worth of Bitcoin in a Lightning wallet. A pledge.
Okay, what do they do?
It allows you to filter interactions. You could choose to only receive DMs or see comments from other orange check users, people who also have skin in the game.
Ah, filtering out the noise.
Exactly. And if a user is verified to be a bot or malicious or violates terms of service, their deposit could be seized or partially seized. It monetizes malice. It creates real-world friction, a cost for bad behavior in cyberspace.
Interesting. So it makes spam expensive.
Potentially prohibitively expensive. Similarly, think about a lightning wall for websites. To access a site, maybe your browser makes a tiny, automatic micropayment fractions of a cent.
Why?
It proves you're likely a real human with a real wallet, not part of a botnet trying to launch a denial of service attack, which floods sites with fake traffic. It provides safe passage.
So building trust and accountability directly into the internet protocol using small amounts of Bitcoin as energy or collateral.
That's the core idea, fundamentally changing the economics of online interaction, making the internet potentially a much safer, less annoying place.
Okay, that is a big idea.
Yeah.
Given all the challenges in traditional finance, Bitcoin is this unique digital property, the layered architecture, these potential internet fixes. Let's circle back to our original question. What is Bitcoin's role in a modern investment portfolio? People still worry, understandably, about the volatility. It goes up and down like crazy sometimes.
That's a very common and, frankly, valid concern, especially looking short term. Opponents definitely point to its volatility during big risk-off market events where it sometimes sells off along with other assets.
Yeah.
But our sources show a different, maybe more nuanced picture when you look longer term or at portfolio construction. Bitcoin has what they call idiosyncratic risks and characteristics.
Meaning it behaves differently.
It dances to its own drummer to some extent.
Yeah.
And historically, that's shown an ability to deliver large, positively skewed returns, meaning the potential upside has been much larger than the downside over time. And studies we looked at show that even small allocations like maybe 1% to 7% in a diversified portfolio can significantly improve the Sharpe ratio.
That's the measure of risk-adjusted return.
Exactly. How much return are you getting for the amount of risk you're taking? Higher is better.
So a little Bitcoin can improve the overall efficiency of the portfolio.
Potentially, yes. And in some simulations, adding a small amount of Bitcoin even reduced the maximum drawdown, the biggest peak-to-trough loss during bad periods.
Really? That seems counterintuitive given the volatility.
It does, but it speaks to its low correlation with other assets over longer periods. For instance, One hypothetical study looked at a pension fund. Started with a standard 50% equity, 50% bond mix.
Okay.
They found that adding just 1% Bitcoin allowed them to actually reduce their overall allocation to riskier assets by 4%, reduce the portfolio's maximum drawdown by over 60 basis points, that's 0.6%, and enhance the total annual return by over 200 basis points, or 2%.
Wow. With just a 1% allocation.
With just 1%. Now, these are simulations, past performance, etc. All the usual caveats apply.
Sure.
But this is precisely why you hear the phrase getting off zero, gaining traction in institution boardrooms. The idea that having zero allocation might actually be the riskier position, given the potential portfolio benefits.
So it shifts the conversation. It's not just about speculation anymore. It's potentially about optimizing traditional portfolios.
Exactly. That's a really key shift in perspective that some sources highlight.
And beyond individual portfolios.
Well, think about corporate treasuries. Companies often hold large cash balances that earn very little, especially now. It creates a balance sheet drag.
Yeah, cash losing value to inflation.
Right. A small Bitcoin position, some argue, could potentially help offset that drag, particularly in an environment of financial repression.
Okay.
And maybe more broadly, think about the global context, political conflicts, persistent inflation. People around the world are experiencing real shocks to their property rights, the stability of their local currencies.
Sure.
The logical response, if you're facing that, is often to convert weak currency to strong currency, think Argentinian pesos to US dollars historically,
Right.
or convert weak property to strong property, maybe selling a physical building in an unstable region to buy something perceived as safer, even if it's abroad. And moving from bank custody, where funds can be frozen, to self-custody,
Where you control it directly.
where you control it. Bitcoin, viewed as this digital property and a bearer instrument, like holding cash in your hand.
Whoever holds the keys owns it.
Exactly. It offers potentially a bank on your mobile phone for people without access to stable financial systems. It offers hope, as Saylor puts it, for those in economically fragile regions.
So the potential market is huge, if you think about it that way.
If you see its addressable market as potentially replacing a portion of gold or certain types of real estate or even some bonds as a store of value, yeah, you're talking potentially hundreds of trillions of dollars. It's not just about what it is, but what problems it solves for people.
This whole discussion feels, well, bigger than just a new asset class or technology. It feels almost philosophical at times. And one of our sources makes a really bold comparison, drawing a parallel between what's happening now with Bitcoin and the internet and a major historical turning point,
Yeah.
the Protestant Reformation in the 16th and 17th centuries.
Yeah.
Can you unpack that? It sounds fascinating.
It really is a fascinating framework. The report argues that Bitcoin's emergence, combined with the internet, encryption, and maybe the mindset of the millennial generation, is heralding a similar kind of profound societal shift.
Okay, how?
The Protestant Reformation, they argue, had 4 key preconditions that seem to be echoing today.
What were they?
First, you had a dominant sort of rent-seeking, monopolistic service provider. Back then, it was Catholic Church, with practices like selling indulgences and its control over information and finance.
Okay. And the parallel today is?
The traditional financial system, according to this view, with its layers of mediation, fees, information asymmetry, bailouts.
Right. The perceived unfairness or inefficiency.
Exactly. Second precondition, a technological revolution. Back then, it was the printing press, huge for spreading ideas, plus things like double-entry bookkeeping, better compasses for trade.
Game-changing tech.
Game-changing. Now, we have telecommunications, the internet, commoditized computation, open-source software, and critically strong cryptography.
The tools for decentralization.
Precisely. Third precondition, a new economic class with something to fight for. Then it was the emerging merchant classes who wanted more economic freedom from the old feudal and religious structures.
And now?
Now, arguably, it's the millennial generation, and maybe Gen Z too, often digitally native, maybe skeptical of traditional finance after seeing crises like 2008, and more naturally embracing digital innovation and ownership.
Okay, that makes sense. What's the fourth?
Fourth, credible strategies for defense and escape. Back then, it was new religious doctrines offering alternative paths to salvation and physical safe havens like Geneva or the Netherlands for those escaping persecution.
And today?
Today, it's cryptography providing defense for assets and communications, and independent digital currencies like Bitcoin offering a potential escape route, a way to opt out of the traditional system if you lose faith in it.
Wow. So the parallels are quite striking when you lay them out like that.
They really are.
And we see these almost like battle cries or mottos in the Bitcoin community, don't we?
Yeah.
Virus in numerous, strength in numbers, don't trust, verify, HODL, not your keys, not your Bitcoin. How do those fit the Reformation analogy?
They perfectly reflect that rebellious, self-sovereign spirit, mirroring the shifts during the Reformation where individuals sought direct connection, whether spiritual or financial, bypassing intermediaries.
Taking control.
Taking control. Don't trust, verify is fundamental. Not your keys, not your Bitcoin, emphasizes self-custody over relying on third parties. HODL, while seemingly a meme, reflects a long-term conviction and resistance to short-term pressures, similar to how early Protestants held onto their beliefs despite opposition. And just as new financial institutions, like the Amsterdam Whistle Bank, emerged back then a reputable, though still imperfect, deposit bank, and new instruments like life annuities appeared, we see parallels today with things like initial exchange offerings, IEOs, in crypto, and a growing need for new forms of insurance and risk management in this space.
History rhyming.
History rhyming. The core historical lesson, as investor Paul Graham puts it, is that fit ideas beat unfit ideas, eventually.
Right.
The fall of Antwerp, a major financial center during the Reformation, actually led to the Dutch Golden Age because the talent and capital flowed to Amsterdam, which was more nimble, more commercially tolerant.
A shift in power.
A shift in power. And the deep insight here, connecting back to Bitcoin, is that it's unstructured simplicity, its network design, and its consensus mechanism, how everyone agrees on the state of the ledger without a boss.
Proof of work.
Proof of work, primarily. It allows rules and incentives to be enforced automatically, without relying on a central authority needing to be trusted. It lets the honest nodes, the participants following the rules, collectively control the network through their computing effort. Much like the Reformation facilitated a shift towards more decentralized, commercially focused systems that empowered individuals and merchants over the old centralized powers.
What an incredible journey we've taken today.
Yep.
Seriously. From looking at potentially unsustainable trends in traditional finance
Yeah, the challenges are real.
to the truly groundbreaking potential of Bitcoin, not just as money, but as digital property, digital energy.
And fixing parts of the internet?
Right.
Yeah.
And then wrapping it up with these fascinating parallels to huge historical shifts like the Reformation.
Yeah.
It really feels like we're standing at a pivotal moment.
It certainly seems that way based on these sources, yeah. We've explored how Bitcoin's layered design might allow for both secure settlement and friction-free high-speed transactions, how it could tackle fundamental internet flaws like spam and bots, and how it might serve as a powerful portfolio hedge against things like currency debasement and financial repression. The core idea running through it all is that through these robust, open, permissionless systems, we might be able to build more ethical, more resilient economic foundations, not just for big institutions, but for individuals everywhere.
So thinking about all this,
Yeah.
what does it really mean for you, the listener, trying to make sense of this rapidly evolving landscape?
Well, perhaps the deeper question for you to consider, beyond just whether to buy Bitcoin or not, is this. In a world that seems to be undergoing such profound shifts in how we understand wealth, how it's stored, how it's transferred, what's the responsibility, maybe for you as an individual or for the institutions you're part of, to critically examine the fundamental assumptions you hold about money and value, and to genuinely consider the potential and the risks of entirely new paradigms emerging? It's really about understanding the changing nature of value itself in the 21st century.